we begin with today's market action. Stocks going on a roller coaster ride as yields move lower. The bond market sending out its clearest warning yet that a recession could be coming, with the yield curve at its deepest inversion since the Great Recession. So is now the time to start worrying? We asked this question because initially when the yield curve inverted, we said, oh, it only lasted for a couple of hours. No big deal. Here we are. What is it? 2 weeks later. It has been at, near, or inverted for the past 2 weeks.
Although threes, tens, inverted back in May.
3 months ago, true. So now we have all these indicators flashing recession, recession, recession. Should we?
Well, I mean, you should always be worried, I think. But I think with worrying comes, and, Pete uses the word all the time, trading opportunities. I think that's what you have now. He said something a couple weeks ago. It stayed with me. The volatility is going to be volatile, and I agree with that. I'm going to say something. I'll say it again. I've been pretty steadfast. I think the market will bottom, the S&P 500, when the VIX prints 30 or thereabouts. And we close today at 20.5. So I think rallies need to be sold in this market, and I think the trend is going to continue to be lower for all the reasons you mentioned. There are other reasons as well. It's not just a U.S.-China trade, and quite frankly, it's not just this inverted yield curve. There are other things going on as well. Market just seems a little tired here, and you go back and look at the way Facebook reacted after they reported a couple weeks ago. You look at the way Amazon reacted when it reported, and to a certain extent, although not nearly as much, Apple as well. So I think stocks have been trying to tell you something. The Russell's been trying to tell you something. And I think, again, the S&P is headed towards lower.
The Russell's trying to tell you something big. I mean, it's traded today. It closed at a low that it has not traded at since January, late January. So down, 16.5% from the highs. I think it's been telling you something similar to what the banks are telling you, too. I mean, look at the price action in the banks today. They opened up when the market was green, but they went red kind of quickly and stayed down. And they really, a lot of them, Citibank, Bank of America, they're sitting on really important support levels. That is one group that does not like this inverted yield curve. If you look at how they've acted since that's happened here, so to me, I think you want to focus on small caps. You want to focus on banks.
The irony of that, I think you're right. And if you overlay a 10-year bond yield of the 10-year Treasury against either small caps or retail, the two parts of the economy that really so far have not rolled over, even though those are parts of the market that have. Again, this country is based upon the small business largely, and if you think about that, they should be feeling very good. Americans' confidence in going out to get a new job right now is spurring them to spend. And right now, that part of the economy is doing fine.
Pete?
Well, I got to tell you, Guy, you were talking about volatility, and yes, it's been extremely volatile, and I expect that to continue, Mel. I mean, I don't know why we're not going to see even bigger fluctuations as we watch this market, because right now we have very little volumes in the market. I mean, you look at the last 6 days, Mel, and I talked about this earlier, but 5 million under our daily average on the derivatives market right now. I mean, the volumes are not there. And so what's that telling you is these moves could get even more exaggerated. So I think it's going to be something interesting along with the algos that kick in. But you're right. When we're trading at a 20.5, call it, on the VIX right now, why couldn't it spike up a little bit more? I mean, we're just a tweet away from seeing a volatility index actually hitting towards 30, in my opinion. Now, we've already seen it get up towards 24. I think we get any kind of a break to the downside, we're going to see a monster, but that will create opportunity. There always will be opportunities, I think, in this market. We've gone through the earnings season for the most part. We know what these companies are looking at, what they're projecting going forward. And so because of that, that gives us a great opportunity to look and find those names.